Here I have given you a list of instances with different explanations and descriptions of preferentials to see how they are presented now in the financial statements. Before we get on with the discussion, just to add small thing, now cumulative redeemable preferentials, it is a financial liability, and dividends are recognized to profit and loss as a finance charge. It is not in the equity statement. Non-cumulative, non-redeemable preferentials are equity, it goes to equity, and its dividends are a profit distributions and should be in the equity statement. Non-cumulative redeemable preferentials compound where both elements are included, then dividends attributable to equity component should be in the equity statement as a profit distribution. Dividends attributable to debt component should be a finance charge in the profit and loss. Similarly, cumulative non-redeemable dividends are partly taken to profit and loss, partly taken to equity statement. So, dividends attributable to equity component should be in equity statements, and dividend attributable to liability component should be in profit and loss. Now, let us look at this. Redeemable preferentials where the dividends are paid at the discretion of the shareholder. Redeemable explains how capital is repaid. Capital repayment has debt characteristics. I made a mistake. Yeah, capital repayment has debt characteristics and dividends are paid at the discretion of the shareholders. So, that is what you need to elaborate now. Dividends are paid at the discretion of the shareholders. It is the shareholders who decide when to pay dividends and how to pay dividends, and that is what you need to be concerned about. We have given the free hand to the shareholders. You all guys can decide how you want us to pay you dividends and when do you want us to pay you dividends. How much do you want us to pay you dividends? So, let those people to take the decisions. Now, if you were a shareholder, just imagine how would you require the company to pay dividends to you. You prefer to collect dividends once in 5 years, once in 10 years, once in 20 years or once in a lifetime, or you prefer to collect dividends within every second and a minute. You being a shareholder, if you were a shareholder, you would invariably prefer to collect the dividends within every single minute, which is not the practice of a company of paying dividends. So, then normally what is the practice? Paying annually. So, then if you were a shareholder, if you given the decision making power, you would request dividends annually or you will just wait by keeping your mouth shut. You will obviously insist dividends annually every year. So, 2015 we had profits, shareholders insisted dividends, we paid, no problem. 2016 again we had profits and we paid dividends, shareholders insisted, we paid, and that is the end. 2017 we are at a loss. Even where the company is at a loss, do you think that the shareholders will keep their mouth shut without asking for dividends? No, they will insist. Then even when the shareholders insist dividends, if you can't pay it since you don't have profits, you will pacify shareholders, you will console shareholders, look here guys, have mercy upon us, please let us pay dividends, current year dividends, next year you will not only get the next year dividends, also the current year. Now, where the dividends are paid at the decision, at the discretion of the shareholders, effortlessly, spontaneously, they become cumulative dividends. So, then cumulative dividends include what characteristics? Debt characteristics. So, now redeemable is capital payment, debt characteristics. Now, the dividend payment is once again debt characteristics. So, this is similar to redeemable cumulative preference shares. So, it is completely a financial liability. B, non-redeemable preference shares where the dividends are paid at the discretion of the issuer. Non-redeemable. So, that explains capital repayment, debt characteristics. And the dividends are paid at the discretion of the issuer, at the discretion of the company. And if you were the company who issued preference shares, what would you prefer to do? You would prefer to pay dividends every year, you would prefer never to pay dividends, you would prefer never to pay dividends. But can you decide never to pay dividends? No. Shareholders will insist. Then 2015 profits, you paid dividend, we have no issue, we can afford. 2016 profits, again we can afford to pay dividends and we paid. 2017 we are at a loss. Can the shareholders ask dividends? No. Why? At whose discretions are the dividends paid? At the discretion of the company. It is the company who can decide whether to pay dividends or not. So, let the shareholders shout as much as they want. Let those people to shout as much as they want, as loud as they want, as long as they want, and let them shout, and we are keeping quiet. You decide whether to pay or not to pay. You have the decision making power. Now, you decide. For 2017 dividends are not paid. Does it mean that the unpaid dividends will be accrued and will go to an arrears account? No, you will not decide so, you are not so generous now. So, if the dividends are paid at the discretion of the issuer, the company, that takes the form of non-cumulative dividend payment. So, then it is non-redeemable preference shares where the dividends are paid at the discretion of the issuer. This is similar to non-redeemable, non-cumulative preference shares, and both of them, capital payment and dividend payment, both of them have equity characteristics, and put it under equity. Third one, redeemable preference shares where the dividends are paid at the discretion of the entity. Redeemable, capital repayment is debt, dividends are at the discretion of the entity. Dividend payment is what? It is non-cumulative. So, this is similar to redeemable non-cumulative preference shares, both characteristics are included together. So, it is a compound instrument. Fourth, non-redeemable preference shares where the dividends are paid at the discretion of the shareholder. Non-redeemable explains how the capital is paid. Non-redeemable, so that capital repayment has equity characteristics. Where the dividends are paid at the discretion of the shareholders, if the dividends are paid at the discretion of the shareholders, that has debt characteristics. So, once again This is where both equity and liability, debt and equity characteristics are sorted and mixed up and blended together. It is once again a compound financial instrument. Perpetual preferentials, I do not know whether you heard this term before, perpetual. What do you mean by perpetual? Endless, infinite. This is something like your romance. Even your romance is endless. Your romance is perpetual. You are expecting your girlfriend, your crush, not only for this birth, also for another few births to come ahead. Perpetual, non-redeemable. We are not going to repay capital until such time the company is wound up. Perpetual is similar and synonymous to non-redeemable preferentials, where the dividends are paid at the discretion of the issuer. If the dividends are paid at the discretion of the issuer, that is synonymous to non-cumulative dividend payment. So, this is non-redeemable, non-cumulative preferentials, once again should be equity. Cumulative preferentials where capital is redeemed at the discretion of the shareholder. Cumulative preferentials that includes debt characteristics, capital is paid at the discretion of the shareholder. So, the company can decide whether to repay capital early or whether to wait without repaying until the liquidations. Company can decide. So, the company, if you were the company, you would decide not to repay capital in advance early, but to repay it in the event of the company being wound up. So, then cumulative preferentials, cumulative explains dividend payments which has debt characteristics and where the capital is repaid at the discretion of the company, that is similar to non-redeemable capital and that has equity characteristic. This is also what a compound instrument. Non-cumulative preferentials where the capital is redeemed at the discretion of the entity. Non-cumulative preferentials, dividends are equity characteristics. Capital is paid at the discretion of the entity. Capital payment also has equity characteristics. That is once again equity item, and that is how you will present. So, we can go forward, and we are coming now to a very important area. Compound financial instrument. Now, you are cognitive about compound concept. This is not, you are not listening it for the first time now. Under preferential classification presentations, we learned to some extent and we heard it couple of times, compound word. We have heard the term, not the concept, we have heard the term. So, you are not scared, you are not having any fears now because you are getting familiar, you are getting familiarized yourself a bit now to the concepts. Now, let me come to the point straight. A compound financial instrument is an instrument where both equity and liability components are included. Let me repeat it, I am repeating it again and again because it is very important. compound instrument is an instrument where both capital, liability and equity components are included. If both equity and liability characteristics are embedded, sorted, blended together, then only we call it a compound instrument. And just as at a glance, you cannot conclude that a particular financial instrument is a compound, and you would have gone right down to the depth of the standard to identify the compound. So, as you all know, if you all have studied from us before, you all know this is not just type of a Cinebola kind of a work. I need to go deep down to the standard. As I said, I want you to drink the cup of the standard right down to drink without just sipping the bubbles floating on the surface. No, we need to go into all the possible nooks and corners. So, we do not know where the examiner will be setting the questions from. Also, we do not know to what extent, to what depth practical scenarios will be encountered in our life. So, I want you to understand the philosophy and the rationale and the ideology and the reasons behind the accounting and the calculations. Without understanding the philosophy and the rationale and the ideology, so no point of going forward. So, as I will take little time to clear my path and then we will arrive at the conclusion. Compound, you know the basic. Just to remind you the basic, a compound instrument is an instrument where both equity and liability components are included together, right. Now, let me move out from my track a bit and let me get back to my track again in a little while. You know, financial instruments are either financial assets, or financial liabilities, right. So, I am explaining compound instruments. I can give you couple of explanations to make you feel comfortable and convenient. Whatever you think is good for you, whatever you think is comfortable with you all guys, you all can take. Let me start now. This is one way of explaining. Financial instruments are either financial assets and financial liabilities. All financial instruments, whether they are assets or liabilities, everything should be initially measured at fair value. We will discuss that under IFRS 9, our next topic. Irrespective of whether it is a financial asset or a financial liability, all of them are accounted and measured initially at fair value. To determine, to measure, to assess the fair value, we have IFRS 13. I will not exaggerate it to that extent, but let me have a simple mechanism. Where do we find fair value from? Either you can take the fair value from the active market, or you can take the fair value from an arm's length transaction. Arm's length transaction, and this is what you need to impress yourself. Either active market is one source where the fair values can be derived from, or arm's length transactions can be another source where the fair values can be derived from. I will just for the moment forget about active markets and let me think about an arm's length transaction. Now, what do you mean by an arm's length transaction? Where there is an arm's length transaction, there cannot be additional relationships. And if the transaction, in addition to the seller being the seller, in addition to the buyer being the buyer, have additional relationships, the transaction is no longer an arm's length transactions, that can be something like a related party transactions. The moment the transaction becomes a related party transaction, the fair value disappears like the mist in the morning before the sun. So, as a result, for you to do the accounting for financial instruments, you need to make use of the fair value. For you to determine the fair value, the transaction is necessarily be an arm's length transactions, where the two parties in the transactions are not supposed to have any other relationships other than them being the seller and the buyer. Now, let me take a simple example. And I wanted to buy a mobile. I just walked into a showroom where there was a girl, and this girl has been one of my previous crush. The normal selling price can be 300,000 rupees, and she will decide to bring down the price from 300,000 rupees to 100,000. Now, the transaction is not arm's length. The value I will pay to buy the mobile, 100,000, is not the fair value. But if the girl, the shopkeeper, is not known to me, neither I am not known to her, and we are keeping this arm's length distancing. Now, distancing is a common concept, social distancing. We are keeping the distance, not 1 meter distance, we are keeping the seller and the buyer distance, and then the transactions is on market terms. I am ready to pay 300,000 rupees, and she is ready to sell me the mobile at 300,000 rupees. So, the transaction is clearly, immaculately an arm's length transactions, and the value is the fair value, 300,000. So, that is enough. Now, here APLC is an entity. There is a boy working in the company Saman, and he wanted a loan. He walked into a nearby bank, met the bank manager and discussed about the loan. The bank manager explained everything, and he said the interest rates nowadays are pretty high, so 20%. What is the loan? How much of a loan he needs? 100,000. And then the bank says, look, we are granting you 100,000 rupees now, and you are supposed to repay in 1 year's time at 120. The interest rate was decided based on existing market forces, and it was not influenced by any other relationships. And this is what is commonly available to everyone, irrespective of whether the customers are related or unrelated or blood related or whatever. And this transaction is purely, immaculately an arm's length transaction. So, the value is which value? The fair value. Then, if the bank granted the loan, loan receivable is a financial asset as per the definitions, contractual right to receive cash. It is accounted for the first time at the fair value. So, what should be the fair value? 100,000. Now, someone is not willing to take the loan from the bank. Interest rates are pretty high, and he can't afford. He changed his mind. A wise man changes the mind, sometimes the fool never. He changes the mind not to apply for the loan from the bank, instead to apply the loan from his boss. Next day morning, early in the morning, he was waiting at the entrance of the room of the boss, and the boss waved him and asked him to come, and the negotiation started. And then he said, sir, I am in need of money, 100,000 rupees. Can I borrow 100,000 rupees from the company? I do not mind paying that in 1 year's time. And the boss is asking here, you have been very good at work in company, I do not mind, we are very positive about you and I do not mind granting you loan. But remember, though you are an employee in the company, we can't help charging interest and we are charging 20% interest, the market rate is that, so you are supposed to pay 120,000. Even though employer-employee relationship is existing, pre-existing, that particular relationship has affected for this loan granting and borrowing transaction, no, has not affected, So, this is not influenced by any other relationship. So, still this transaction is on arm's length basis. So, the value of loan granted 100,000 immaculately, purely fair value 100,000. Now, boss is asking a question from someone. How old are you now? 27. For how many years have you been working for this company? 25 years. Look funny. And then boss says, no problem, that fact has to be taken account of. We will grant you 120,000 rupee loan and you are supposed to pay us in 1 year's time at 120. Someone took a relieving breath, why he need not to pay interest now? And this is what is very important to understand. Market rate is 20%, but employer is charging only 0%. Is the transaction arm's length? Not at all. Where the transaction is not arm's length, can the value be expected to be the fair value? Not at all. If the fair value is not available, can we recognize financial assets? Cannot. Then you need to find out fair value. Right. For you to find out the fair value, you need to transform this non-arm's length transactions to arm's length transaction. How will you do it? So, there are two relationships now. What are the two relationships? Employer-employee relationship, lender-borrower relationship. So, which relationship need to exist? You need to keep only lender-borrower relationship and you need to remove employer-employee relationship. Now, here it is very simple. It is only just that you need to settle your mind to understand this. Now, someone has to pay how much? 120. Then, if someone was just a borrower without being an employee in the company, what interest rate would the company grant the loan at? Then the interest rate wouldn't have been 0%, interest rate would have been 20, market rate. If the loan was granted at 20% rate, the transaction is now arm's length. And if employer-employee relationship did not exist, for someone to pay 120,000 rupees in 1 year's time, what value of loan would the company grant? The 120 has to be the value of loan principal plus 1 year interest accrued at 20%, then originally loan value would have been how much? 100,000. Then if not for the employer-employee relationship, to recover 120,000 rupees in 1 year's time, the value of the loan that the grantor would have granted has to be 100,000 rupees, and that is the value of the transaction. Which transaction? Arm's length transaction. And that is what you need to bring to loan receivable. But employer granted 120,000 rupees, no? Yeah. And you need to be wise without being otherwise. You have to look at it in a very intellectual view. And you need to expand your circumference of intelligence to understand this. Here, that's like the employer acting two roles. First, employee is calling the employee. The employer speaks as if he is the bank. You are my borrower, we are granting the loans at the market rate, we are granting 100,000, give us 120 in 1 year's time. It's like the lender-borrower discussion. Then again the same grantor, same lender speaks as if he is the employer. Since you worked for us for 25 years, we should be loyal to you. We should be loyal to you, and we are giving you another 20,000 rupees. This is not a loan, you keep it and we don't expect you to return, and that is like a benefit given by the employer to the employee, and that is under LKS 19 employee benefit. Then you all will wonder, what connectivity does this have with compound? And you will get that connectivity in a little while. So then, I will have another explanation for this. Here, now 120 was granted, expecting 120 rupees in 1 year's time. Now, you need to decide its fair value. To decide the fair value, you need to make use of SLFRS 13. SLFRS 13 has given you lot of inputs. 20% is an input under level 2 category. Then for you to calculate the fair value of the loan granted, what you can do is you can discount future cash flows by the market interest rate, and then you get 100,000 rupees, that is considered to be the fair value of the loan granted. That is the technical explanation. So that is what is included in the standard. Here you need to understand the ideology and the philosophy and the rationale behind it, and then only you are perfect, then only you are proficient in the subject. So then, let me take another example. Company A has acquired company B. So company A is the parent company. Company B is the subsidiary company. Market interest rate is 20%. Company A granted 100,000 rupees to company B at 20% market rate interest. B is supposed to pay 120,000 rupees in 1 year's time. Irrespective of company A being parent and irrespective of company being subsidiary company, the loan was granted purely at the market interest rate. So the transaction is purely an arm's length transaction, and the value should be the fair value. Now company A says, we are granting you 120,000 rupees loan now and pay us 120,000 rupees in 1 year's time. Market rate is 20, but we are not charging any interest from you all guys. Why? What makes company A grant the loan to company B at 0%? It is because parent is A, company B is subsidiary company. Now the transaction is not arm's length and the values are not considered to be fair values any longer. then you can't do the accounting for financial instruments, you need to convert that into an arm's length transactions and to find out the fair value. How will you do that? Just imagine we were like the bankers and the borrowers in the market. Then for us to collect 120,000 rupees in 1 year's time, what would have been the loan to be granted today at the market interest rate? For the transactions to be arm's length, the rate has to be market. For the loan recoverable value to be 120,000 rupees in 1 year's time at 20% market interest rate, the loan to be granted would have been 100,000. Now that is what you will debit to loan receivable. But parent company granted 120, no? Yes. So you need to settle your mind to accept the truth. It's like company A acting first as a bank and granting a loan at the market rate at 20%. 100,000 loan was granted to recover 120. Now company A is like a bank in the market. And the balance 20 was given as what? Balance 20,000 has been given A as the parent and B as the subsidiary company. So you debit to loan receivable by 100, 20 is debited where? It's not a loan, that's like an investment made by the parent in the subsidiary company. See how logical it is. Let me take the other way. Now, it is the subsidiary company which is granting the loan to company A. Irrespective of this relationship, company B is granting 100,000 loan to company A at 20% market rate, expecting 120,000 rupees in 1 year's time. So the transaction is purely arm's length, and 100,000 should be fair value, and then you can bring it to financial asset account. Then subsidiary company says, no, since you all are our parent company, we are granting 120,000 rupees loan, expecting 120,000 rupees in 1 year's time. Now this transaction is at 0%. Since it is not at the market rate, the transaction is no longer at arm's length or commercial terms. Where the transaction is not arm's length, the values are not considered to be fair values, then you can't do the accounting for financial instruments. You need to find out fair values. How? Just imagine company B was a banker in the market and A was a borrower in the market. No relationships at all whatsoever additionally. Then for company B to recover 120,000 rupees in 1 year's time, what would have been the loan value originally at 20% market rate? Loan value would have been 100,000. And company B has given and granted altogether 120 years. Now company B is acting first as a banker and granting 100,000 rupees at the market rate, expecting 120,000 rupees in 1 year's time. And the balance 20,000 is like a payment which the subsidiary company does to the parent, and then it becomes dividend payment from company B to company A. See how logical it is. The last and the final illustrations, and then I am coming straight to compound. Company A obtains a loan at 1 million rupees at 20% rate, and that is from the government. So, irrespective of this citizen and government relationship, government has granted the loan at 20%, which is the market rate. So, the transaction is purely arm's length. Then this value 1 million should be the fair value. So, we can credit to loan payable at 1 million rupees. Why? Financial instruments are initially measured at fair value. Now, the government says as a concession, as a support, as part of the fiscal policy of the government says no, we are granting you 1.2 million rupees now and we will recover 1.2 in 1 year's time. Now, the rate is 0. Since the rate at which the loan was granted to us is not the market rate any longer, can this transaction be considered to be arm's length? Not at all. In the absence of an arm's length transactions, can there be fair values? Not at all. Then what you must do is, you need to convert that into an arm's length transactions to find out the fair value. Here, government is now acting two roles, playing two roles. What are these two roles? The government is now acting like a banker and giving us a loan of 1 million rupees, expecting 1.2. Then we are like a borrower in the market receiving 1 million rupees to pay 1.2 million rupees in 1 year's time, and the balance 200,000 is like a grant and a donation or subsidy given freely by the government to us without expecting it back to the government. So, for the balance 200,000 we will apply LKS 20 government grants. You credit 200,000 to government grants and 1 million is credited to loan payable. Now, that is what is happening in nitty-gritty. That is the philosophy. That is what you need to impress yourself with. But what the standard says is something. Standard gives you only the accounting treatment. And if you have taken 1.2 million loan, and if you are supposed to pay 1.2 million rupees in 1 year's time, it is 0% interest. What the standard says is you need to determine the fair value. For you to determine the fair value, you need to discount future cash flows by the market interest rate. That is what we write at the exam also. You need not to write all these fancy stories that I told you now. If you calculate the fair value by discounting the future cash flows by the market interest rate, you get the fair value. That is the technical version of it. And the previous was the simplified versions and in the language which you and I understand. Here we will come to compound now. You need to apply the same principle. Now, we will take a loan 1 million, market rate 20%. How much to be repaid? 1.2. Are our borrowings at the market rate? Yes. Is the transaction an arm's length transaction? Yes. Are the values in the transactions fair values? Yes. Can we credit our financial liabilities by 1 million rupees? Yes. Right. Now, we will take a loan 1.2 and we are expecting to pay also only 1.2. Market rate is 20 and what is the rate at which we have taken the loan? 0%. So, what makes the lender grant us the loan at 0%? There has to be some relationship or other additional. If not, the lender would never give us the loan at the 0 rate. This is the additional relationship. Now, we are in company A, we are the borrower. Lender is company B. We will say, look here, lender company B, we will repay the loan in 1 year's time, but you have a choice. Life is completely a choice. Now, you can decide, you can make a choice either to stay at home, or you can make a choice to stay in the hospital, or you can make a choice to stay in a photo frame. Choices. Likewise, we have given a choice to the lender. What is the choice? Either you can receive the loan back, recover purely in cash 1.2, or if you are interested in, you can receive 100,000 shares of our company in 1 year's time in settlement of the loan. It's not we who decide, it's you who decide. Tell us how you want us to pay you in 1 year's time. Need not to panic, you can take your time. In 1 year's time, tell us. Now, company B has been given the privilege of being a shareholder of our company, and that additional privilege and the opportunity given to company B has made company B grant us the loan at 0 interest rate. Now, company B is not just a lender. Company B is not only a lender, is also a prospect shareholder in the company. It's like you taking a loan from somebody and settling the loan by giving the daughter as the settlement. So, the lender is not only a lender, is also the future prospect son-in-law. So, when the prospect son-in-law grants us the loan, it cannot be the market rate, it has to be a lower rate. Then, here 1.2 is the amount to be settled. Now, company B has to tell us how they want us to settle in 1 year. If they are interested in cash itself, we do not mind paying in cash, and if they are interested in shares, we do not mind issuing shares in 1 year's time. That is up to them to decide, we are keeping quiet. Now, since the transaction is not arm's length, values are not the fair values, you need to find out the fair value. How do we find out the fair value? In our normal language, you need to convert this into an arm's length transaction. How? If the option was not given to convert it into share capital, market rate would have been 20, and that is the rate at which the loan would have been granted. Then, for 1.2 million to be the recoverable value in 1 year's time, at 20% market rate, what would have been the loan to be granted? 1 million. Then, you credit 1 million, which is the fair value to loan payable, the balance 200,000 is what? Is like the amount given by the future prospect shareholder. This is taken to liability, this is taken to equity. This is like the loan given by the lender, this is like the capital given by the future prospect shareholder. Loan given by the lender should be a liability, and the capital given by the prospect shareholder should be equity. So, within the same instrument are there equity as well as debt components, and then only it becomes what? Compound instrument. And that is our simplified explanation. Technically, the transaction is not arm's length and the fair value is missing. How do we calculate the fair? This is what you need to write in the answer, not the previous one. To find out the fair value, future cash flows are discounted by the market interest rate. Future cash flows are 1.2 and discounted by the market rate, and then you get the fair value. Then here total loan value is 1.2 million rupees and liability value is 1 million rupees, and then the balance is taken as what? 200,000. That is another way. That is the most popular one. Then another one, we will get back to conceptual framework. Amount to be paid in 1 year's time should be 1.2, and this is not the present obligation. For that to be a liability, remember it is a present obligation as a result of a past event. This is a present obligation to transfer economic resources arising from a past event. To convert that into a present obligations, you need to discount it by the rate. It is not just the rate, it has to be discounted by the market rate, 1 million. Then how do we measure equity component? Again the conceptual framework. So then liability value, future value is 1.2. You need to calculate the present obligation of your liability. To calculate the present obligation, you discount it by the market rate. Then you get 1 million. Then apply the definition of equity in the conceptual framework. Equity is the residual interest of assets after deducting liabilities. Then proceeds collected from debt instrument 1.2 million minus fair value of the liability 1 million rupees, 200,000 equity. Why? Equity should be residual interest of assets after deducting all liabilities. It is falling in line with the requirements of definitions of the conceptual framework. So now to summarize, compound instrument is an instrument that includes both equity and liabilities. How do we measure liability? Fair value is measured by discounting the future cash flows by the market rate. Fair value of the liability is deducted from the proceeds of the debt in order to calculate the equity. So one example for compound instrument is, as we discussed under preference shares, cumulative non-redeemable preference shares. Another example, non-cumulative redeemable preference shares. Another example, cumulative participative preference shares. Another example, the example we just learned, a debt instrument with a conversion option where the interest rate is lower than the market rate. Option is given to get the loan converted into ordinary shares, and that makes the lender grant us the loan at a lower rate. So we will go to a comprehensive example and then we can move on. So, this is, you can see, this is how you do the will do the calculations, and then we will come here. So, let us go to a question example. First January 2015, APLC issued a 50 million 5-year bond at par. The coupon rate is 10%. Do not worry about coupon, we will learn it later. That is what the company has agreed to pay, and is payable in arrears on 31st December. So, the interest is paid at the end of each year, not at the beginning. The bond is redeemable at par on 31st December 19. The bond holders may opt for conversions in the form of shares. The bond is convertible into 5 million ordinary shares. The bond issued by similar entities without any conversion rights is 15% required to determine the amount of equity and liability component. So, this is a debt instrument. We have taken a loan. When the market rate is 15%, we are supposed to pay only 10. Why? To the lender, we have given the chance and the privilege and the opportunity to get the loan converted into ordinary shares. To make a long story short, they are given the privilege of being a shareholder of the company. Future prospect shareholders are very close to the entity, so they are kind hearted not to grant the loan at the same interest rate in the market at a lower rate. So, of this loan of 50 million, partly there is capital infusion, partly there is liability at the market rate. So, let us work it out. We will forget about everything else and we will get on with the technical language to calculate the fair value of the loan liability. You need to discount the future cash flows. So, there are 5 years, or rather how many years are there? 5 years are there. Take the years, take the cash flows and take the present values. First year end, second year end, third year end, fourth year end and fifth year end. First year end 5 million is paid, discounted by the market rate 1.15. Second year end another 5 is paid, discounted by market rate 1.15 to the power 2. Third year another 5 is paid, 1.15 to the power 3. Fourth year 5 million will be paid, 1.15 to the power 4. Last year you not only pay the interest, also you need to pay capital 55 million divided by 1.15 to the power 5. Here the present value is 4,347,826, 3,780,718, 3,287,581, 2,858,766, 27,344,720. Take the total down, 41,619,611. This is the fair value of the liability. Then you need to find out the capital portion as well, equity component. To calculate the equity component, what do we do? You apply the definitions in the conceptual framework. Residual interest in assets after deducting liabilities. Let us take proceeds from the debt instrument, 50 million, minus fair value of the liability, 41,619,611. Equity component, equity component should be nine, this is 8, this is 3, this is 0, this is 8, this is 3, 8,380,389. Now let us see how the accounting looks. Let me open up two accounts. Equity, debit cash and credit equity by 8,380,389, and then credit to liability. Debit cash and credit liability by 41,619,611, and this equity part does not need any remeasurement at the end, but liability component requires a remeasurement. So, that part I will not explain right now, it is a part of the discussions under IFRS 9. I will update the liability account just to show you how we do the settlement at the end, and accounting part in between will not be clear, do not worry, we will learn it under IFRS 9. We will recognize interest to the first year, that goes to profit and loss, 6,242,941, and you need to pay interest. End of the first year, how much of interest do you pay? 5 million. So, then the balance, balance end of the first year is 42,862,552. Balance at the end of the second year, $42,862,552. Interest 6,429,383, and you keep on paying, you go on paying interest 5 million, credit cash and debit to liability. So, this is 49,291,935. 49, 291, 935. So, the balance is 44, 291, 935. At the beginning of the third year, 44, 291, 935. Then interest to the third year, 6,643,790, and let us pay interest now in the third year. It is 5 million. This is 50, 935, 725, 50, 935, 725. So, the balance is 45 million, 935, 725. Balance 45, 935, 725. Interest first, second, third, the fourth year now, 6,890,359. Pay interest 5 million. $52,826,084, 52,826,084. So, this is 47,826,084. Balance at the beginning of the fifth year, 47,826,084. Interest is 7,173,916, and then you pay interest in the last year 5 million. Then the balance has to be 50 million, 55,000, 55 million, 55 million. We recognize interest every year over 5 years time at 15%. Why? We will explain later. This is what I want you to understand. Now 5 years gone, we have to repay. So, we will speak to the lender. He can decide how does he want us to pay. If he wants us to pay in cash, credit cash and debit to liability by 50 million. And if the lender requires us to pay by issuing him shares, how many shares? Whatever the number of shares, it is 5 million shares, then you debit liability by 50 million rupees and then you credit to share capital by 50 million. Just because you transfer 50 million to share capital, nothing happens to previous equity, that remains as it is. So, do not get the wrong end of the stick. And now, that is all about it, and there is another example given. I will not work it out fully, but I will give you the cash flows, then you can complete the rest part of it. First, January 2015, APLC issued 40 million 4-year bond at par. The coupon rate is 12% and is payable in arrears on 31 December. The bond is redeemable on 31 December 18 with a premium of 8 million. The bond is with a conversion option into 4 million ordinary shares. The market rate of interest of a similar instrument without the conversion option is 18%. Year cash flows, present values, first year end, second year end, third year end, fourth year end. So, it is 40 million into how much of interest to be paid? 12%, that is 4.8 million. 4.8 million, 4.8 million, 4.8 million plus 40 million plus another 8 million premium should be paid at the end. So, it is all together 52,800,000 discounted by the market interest rate. How much? 18%, 1.18, 1.18 to the power 2, 1.18 to the power 3, 1.18 to the power 4. Take the fair value of the liability, and the rest can be continued by y'all. Then we will go to another small area in the standard. Treasury shares. What do you mean by treasury shares? You can find it out. Treasury shares are own shares that an entity has acquired. When an entity acquires its own existing shares, the consideration paid is presented as a deduction from equity. No gain or loss is recognized even if the price paid differs from the amount at which the shares were originally issued. If the entity subsequently resells treasury shares, no gain or loss is recognized. Difference between the price or value at which they are sold and the purchase price is not reported gains or loss in the statement of comprehensive income. It is an adjustment in the equity that only appears in the statement of changes in equity. Right. And in the previous explanations, I said sometimes a company can purchase their own shares for various reasons, to keep their EPS constant or to satisfy the requirements of a share based payment transaction. So, let us see how the accounting is and how we do the presentations of treasury shares under LKS 32. Now, say a company has ordinary shares, reserves, balance as at 1st January 2019, 10 million, 7 million, shares 10 million denominated by 10 rupees shares. So, there is 1 million shares in issue. For some reason or other, company decided to repurchase their own shares. Shares have been issued at 10 rupee originally and the company repurchases shares at 15 rupees. We collected only 10 rupee at the share issue, but you need to repay 15 at the repurchase, and then we are losing 5 rupees. So, there is a loss of 5. LKS 32 says losses or profits on share repurchase, treasury shares need not to be recognized. And if you decide to repurchase 100,000 shares, 100,000 shares at 15 rupees, it is 1.5 million. This is recognized into a separate equity item. Treasury shares 1.5 million, this is a debit balance. So, nothing else is required. Then we will go to another important area, offsetting financial assets and financial liabilities. Setting off can be set off two financial instruments, a financial asset and a financial liability. It is like this. We are in company A and we have sold goods to company B, it is 50 million rupees. And we have purchased some property, plant and equipment from the same party whom we sold the goods to. That is 40 million rupees and we have to pay him 40 million. So, the same company B becomes not only a debtor, also becomes a creditor. Now, 50 million is a financial asset, 40 is a financial liability. Is it that we show 50 million rupees and 40 million rupees separately, or is it that we will show 10 million net amount as one single item? If you show 10 million, that is called what? Offsetting financial assets and financial liabilities. And you can't do this setting off the way you and I like. LKS 32 stipulates instances where this offsetting is possible. It says offsetting is presenting net amounts of financial, it says offset is recognized, okay, is possible when an entity currently has a legally enforceable right of set off and intends either to settle the asset and liability on a net basis. We never entered into a contract to make the net settlement, and there is no legal enforceability as well to do the net settlement. So, then in the balance sheet of A, receivable 50,000 should be shown separately, payable 40 million should be shown separately. You cannot set off. Why? When you do the disclosures are provided to show different timings of cash values, different amounts of cash flows and different risk levels of cash flows. If somebody before that 50 million should be received by the company in 3 months' time and 40 million should be paid in 1 year's time, the timing of the cash flows are different, inflows and outflows are different. If somebody prepares a cash balance looking at the balance sheet and the profit and loss, there is a cash inflow in 3 months' time and a cash flow in 1 year's time. If you net them off, is it in 1 year's time or in 3 months' time? The person who prepares the cash flow looking at the balance sheet and the profit and loss will be wrong. So, then these separate disclosures are required for cash inflows and outflows of assets and liabilities where there are different amounts, different timings and different risk levels. Here the amounts are different, timings are different, risk levels are different. So, separate disclosures are required, but let me take a contrasting example. A entered into a contract with B. What is it for? A promised to transfer the rupee value of $10,000. Now, rupee value of $10,000 is 1.8 million. B promised to transfer 3 million rupees. Contract date is 1st January 19, exchange has to take place on 31st March 19 in 3 months time. And this particular agreement was entered into in such a way that there will not be two cash flows, either way one party has to make the net settlement. So, the both parties intend to do the settlement in net. The agreement itself says that it is not required first A to make 1.8 million rupees to B and then B to make another cash flow 3 million. There is a legal enforceability for both parties to do the settlement in net. Now, here A will recognize only 1.2 million rupees net amount as a receivable, B will recognize only 1.2 million rupees as a liability net amount. Why? Currently has a legal enforceable right to set off, and both parties intend to settle and receive in net. And here offsetting is possible. In my previous illustration, offsetting was not possible. Then we will come to the last topic in the standard, contingent settlement provisions. You know what contingency means? You become liable to pay only if a particular event occurs in the future which is not within the control of the entity, and that becomes a liability only if a particular event in the future occurs which is not within the control of the entity. Let me take an example for this, say financial guarantee contract. Financial guarantee contract, right. And before this I must tell you just a small point, and that will be supportive and complementing you all. Say company A has 10 million worth of ordinary share capital. This is not financial liability, we learnt it, share capital. Why? A has a conditional, I made a mistake, A has an unconditional right not to repay 10 million rupees ever until the company is wound up. Unconditional right is there to avoid cash flows. Unconditional right is there not to pay. Then see, company A has issued preference shares where the dividends are paid at the discretion of the shareholders. It's the shareholders who decide whether to or not to pay dividends. It is the shareholders who decide how much are dividends to be paid. Here the dividends are cumulative. Cumulative dividends should be a financial liability. Why? Contractual obligation to deliver cash to pay dividends, and here another supportive reason to recognize that into liabilities, because the entity does not have an unconditional right to avoid that dividend payment. No unconditional right to avoid the dividend payment, and as a result that becomes a liability. For you to recognize something as an equity, there has to be an unconditional right to avoid the payment. Now, how does a financial guarantee contract operate? Let me come to the discussion straight. Company A and Company B. Company B wanted a loan, 1.2 million. B has been well known of being notorious and has been notorious of defaulting capital payments and interest, and B's name has got blacklisted almost everywhere. So the bank says, now the company B wanted the bank loan, and the bank says we don't mind giving the loan at 20%, the rates are little high and we are not, your credit risk is very high. And then the transaction is arm's length. The loan value is now not 1.2, it is 1 million, and in 1 year's time the amount to be repaid should be 1.2. So the transaction is purely arm's length, the value has to be fair value, debit cash and credit to 1 million rupees, that is how it is recorded. Now, Company B shares this incident with Company A, the parent company. A is the parent and B is the subsidiary company. Parent company has been well known for being good in debt settlements. On the spot, not even a single day of delay, right on the spot, I mean exactly the way they have agreed, all the settlements have been done with all the banks and they have got their name cleared. And the bank of Company B says, if somebody gives us a guarantee whose creditworthiness is very high, credit risk is very low, if somebody gives us a guarantee to pay us on behalf of you in case you default, we don't mind granting the loan at 0%. So Company A speaks to the bank of Company B, and Company A will get the bank of Company B to grant the loan not at 20% market rate, at 0% interest now. So it is the involvement of Company A that makes the bank of Company B grant the loan at 0%. So then, if the loan value is 1 million rupees, Company A has given kind of an assurance, and you will wonder whether SLFRS 4 also applies, that is a different matter, do not get confused right now. A has given kind of an assurance to the bank of Company B, if Company B defaults, please nothing to worry, you will not be losing anything, don't go behind Company B, speak to us straight and we will pay you. It is a guarantee given by Company B. What kind of a guarantee? Credit enhancing guarantee, and that enhances the reliability towards the bank of Company B. So then, whether Company A becomes liable to pay this loan of Company B depends on whether company B pays on time or whether company B defaults. If company B makes the payment on time, and A will be relieved. If company B defaults, and then A has to shoulder for someone else's problems. So then A need not to recognize 1 million. Why? Then your financial statements are wrong. A is not pretty certain about whether they need to pay 1 million rupees or not. If there is a material cash flow uncertainty, you do not recognize financial liabilities. You can remember the conceptual framework. Why then it is not relevant financial, it is not relevant information. But A has to recognize financial guarantee as a liability, and that is what you need to understand well. That is what you need to impress yourself about. Now, you need to settle your minds well to accept this. Market rate is 20. If company A does not get involved, company A gets 1 million loan and settles at 1.2. So then 200,000 should be interest. The transaction is purely arm's length. The values are fair values, no problem. If company A gets involved and gives a bank guarantee to the bank of company B, B can get 1.2 million rupee loan and settle it at 1.2 in 1 year's time, and then the rate seems to be 0. Now you need to look at it differently. It's like company B receiving 1 million rupees from the bank at 20% interest rate and receiving balance 200,000 from company B. Let me repeat. If company A does not get involved, loan value is 1 million rupees and should be settled at 1.2 in 1 year's time. So the rate is 20, the transactions is arm's length, the fair values are there. If company A gets involved, interest rate is 0 and loan value is 1.2 and the settlement value should also be 1.2 million rupees. Now the transactions are not arm's length, the values are not the fair values. You need to calculate the fair values. How? If A's involvement was not there, to pay 1.2 million rupees, what would have been the loan value? It's 1 million rupees. But company B gets 1.2 million rupees. What is it looking like? That's like company B receiving 1 million rupees from the bank, and it's like company B receiving 200,000 rupees from company A, and 1 million received from the bank should be credited to liability account, and 200,000 which they collected from company A, it's like it's how it is looking like now, should be credited where? Should be credited to equity account. That is how you need to transform. That is what you need to transform that into. That is how you should interpret that. Company B is receiving 1.2 from the bank, true, but at 0%. So what makes the bank grant the loan at 0%? That is not anything else but A's involvement. So then you need to interpret that different. That's like company B receiving 1 million rupees from the bank, and that's like company B receiving 200,000 rupees from A, and the amount which company B received from the bank should be the liability, and the amount which company B received from company A should be like a capital infusion from the parent to the subsidiary company, should be part of equity. Then if you come to parent company, parent company has not to recognize 1 million liability, has to recognize only their bank guarantee as a liability. What is the value of the bank guarantee? Bank guarantee value is how much? 200,000 rupees. So, company A debits investment account by 200,000, credit to bank guarantee by 200,000. Why? Company A has to pay the value of the guarantee to the bank of company B on behalf of company B. So, that is like company A investing 200,000 rupees in company B, debit to investment by 200,000 and credit to bank guarantee liability by 200,000. Let us work out. A simple example. APLC has provided a credit enhancing guarantee for a debt instrument issued by BPLC, which is a subsidiary of APLC. Face value is 7 million. Coupon interest rate 10% and market interest rate of a similar instrument without credit enhancing guarantee is 15%. So, explain the accounting in company A and company B. Let me first work out fair value of the liability. Here cash flows present values, first year end, second year end, third year end, fourth year end. 700,000 divided by 1.15, to take the fair value you discount the cash flows, future cash flows by the market interest rate. 700,000 divided by 1.15 to the power 2. 700,000 divided by 1.15 to the power 3, 7.7 should be paid at the end, 1.15 to the power 4, 608, 696, 529, 301, 460, 261, 4,402,450, the total is 6,708,000. Then value of the guarantee proceeds from the debt instrument. $6,708,000. Made mistake. Should be 7 million minus fair value of the debt instrument, 6,708,000. Value of the bank guarantee, $999,292. Then let us see the accounting in the books of either company. Debit cash and credit equity by company B by 999,292. Debit cash and credit to liability debt instrument by 6,708,000. Company A debits investment and credit to bank guarantee liability. Debit investment and credit to guarantee liability by 999,292. Right. Now, first year end, company B has to pay interest, but they recognize the accounting part will not be so clear, that is all right, and they should recognize the interest at what rate? At 15%. So, then 6,708,000 into 15%, 900,106, and they should pay interest annually 700,000. Right. The balance is this. Since company B paid first year interest without a hassle, now it looks like company B keeping to their promise, and if company B continues to pay interest and the capital at the end, company A does not have a problem, company A can get relieved themselves from the burden. So, as a result, what the standard says is, as company B goes on paying interest and capital at the end, gradually bit by bit, company A who gave the guarantee is getting released from their liabilities. So, then company A has to amortize this liability over the maturity term of the debt into profit and loss, that is 4 years time. So, 999 999, 292 divided by 4, and that 1/4 of the guarantee liability has to be transferred to the profit and loss of the parent company, credit profit and loss, and debit to bank guarantee liability. 999, 292, 999, 292, balance is 749,469. In case end of the first year, company B defaulted, does not pay, then company A's liability will not be the bank guarantee liability. Now, if company B defaults, the liability of the company A should be the bank loan, and then this amount should be derecognized. Instead, liability value should be recognized to the books of company A. And this is something similar to best man in a wedding. Best man, what is the role of the best man? Best man is responsible of taking over the responsibility of the bride if the groom dies. Now, here company A is playing the role of the best man, still not the groom. A has to take over the responsibility of the bride, which is the bank loan, only if company B defaults. Now the groom dies. Who has to take over the responsibility of the bride? Best man. Now company A is not the best man anymore. He cannot play the role of the best man. He has to take over the responsibility of the bride now. Still, the groom is alive and he has to play the role of the best man. Then we will get on with the second year. We will recognize interest to the second year, 6,200,000, 814 into 15%. 930, 122. Cash 700,000. 6, this is 3, this is 10, this is 3, this is 1, 7. 7,130,936. $6,430,936 should be the balance. Since company B settled the second year interest as well, now company A is relieving bit by bit from their responsibility towards the bank of company B another 249,823 can be transferred to profit and loss of the parent company. So, what is the balance amount? 749,643. 749,649 minus 249,823. So, it is 499,826. Now, if company B defaults end of the second year, now the groom dies. A is no longer the best man. A has to take over the responsibility of the bride. Similarly, just playing the role of the best man is not what A is supposed to do now. A has to forget about being the best man and A has to immediately act upon as the groom, and now the responsibility and the liability of A is not the guarantee. Responsibility of the company A should be the bank loan, de-recognize this amount and immediately bring the bank loan as their liability. So, this is how it continues, and this is what you mean by contingent settlement provisions. I took bank guarantees as an example illustration. And this is the end of our discussions of LKS 32, bit of a heavy and a bulky discussions. And we appreciate your contributions of watching this video and learning something. I hope we have been able to take you through each and every single element of LKS 32, and if you study something, that is our pleasure, complacency and happiness. Thanks for watching our videos. We are coming back with the balance part of financial instruments. SLFR is 9. Till then, stay safe. Bye.